Hello and welcome. Thank you for taking the time to view our short market video this week. Over the past week or 10 days, the talk of the financial markets has been around the European financial sector. The banking sector in Europe has led the downside of all global markets. It might be interesting to look more into why investors are worried and to understand if these shares, if they're down, if they're worth buying or they really should be avoided. So let's get started. Let's understand bank stocks. So recently we've seen general market weakness globally, and they've really been led by the bank shares, and we'll show you the charts a little later on. Now the investors are concerned about the following issues. Number one, negative interest rates. So what do we mean by that? We basically mean that if you bought a bond, say in Germany, for the next 5 years, you would lose 0.52% every year. The yield to maturity of the 5-year bond is minus 0.52. The 10-year bond yields only 0.264 as the time of this recording. Now, imagine you have to be very, very cautious to accept less than inflation and lock up your capital for the next 10 years. And it's not only Germany. In France, we're seeing yields in the 10-year area around 65 basis points, and the 5-year yields for the French government bonds is negative 0.12%. So we'll explain a little later the ramification of negative interest rates specifically for banks. So why are banks being sold off? Well, negative interest rates, we just talked about that. The effect of petrodollars being redeemed or pulled from their balance sheet and their products. European banks were very, very active in the oil and gas sector, either by issuing loans to oil and gas producers, by helping them hedge their production. The European banks were very, very active in raising capital, whether it was debt capital or equity capital for oil and gas producers. And they also helped the owners of these oil and gas companies, whether it be private owners or sovereign funds, redeploy the profits by way of reinvestments. Now, we can all agree at sub $30 oil, these activities have dried up. And in some cases, they've actually reversed. In other words, some sovereign funds and shareholders of oil and gas companies are selling their investments, their old profits or retained profits, to raise capital in order to plug holes in either their personal budget or in their country's operating budget. Now, because oil is such an important economic activity, many investors are worried about the economic slowdown. Lower oil prices have not fully translated into helping other sectors like, say, the consumer side of the economy or the large energy users like manufacturing. So basically what we're seeing is slowdown in the oil and gas related areas. We haven't seen the pickup or the benefit economically from other areas. So right now we're sort of in a transition phase from one very hot sector, oil and gas, completely shutting down, and the benefits not translating through just yet. So it's important to remember that banks are really the transmission of the economy. Economic activity flows through the banks. So before we delve into that, let's look at the charts of these banks. So what we see here is, I've just highlighted 3 sectors. So we have the European banks up here, the Canadian banks here, and the US financials over here. So obviously the European banks have dropped the most. They're down 33% since July, and really the drop accelerated in the new year. Canada has been much more stable. Some would argue it deserves to be much more insulated from the performance. Others, however, say that it's the calm before the storm. The U.S. financial is somewhat perplexing, really, because U.S. financials were not and are not that active in the oil and gas sector, if we were talking about the large financials. And so the sell-off is really on the back of an economic slowdown. So let's understand the bank for a minute. So you have basically a bank's assets are their loans, intangible assets, which would be other companies they would have purchased, like goodwill, and other assets. Think of derivatives, for instance. And then the deposits is when you and I will go to the bank and either buy a GIC or other short-term deposits. And the difference is the equity. So as a shareholder, that's actually what you buy. So to recap, banks take in deposits and then make loans out. And they make a profit, a spread, which is called the net interest margin. It's really the fees that they charge on the loan versus what it costs them to fund this loan. And that's really what banks do. And this net interest margin is what shareholders will make as a profit, essentially on the spread between these loans. So why do I say that banks are a transmission? Well, if you have a very strong economy, this activity of taking in deposits and making loans actually accelerates. It's called the velocity of money. What kind of profits are we talking about? Well, if we look at 3 banks in the last quarter of 2015, Wells Fargo had a net interest margin about 3%, TD about 2.94, But if you look at a German bank like Deutsche Bank, the net interest margin was about 0.9%. Why is that? Well, if your average 5-year bond is negative, that means you're really not making any money on your loans, because loans are based on 5-year or even 10-year interest rates. So as these interest rates become negative, banks are not making as much money. This net interest margin is falling. And so even though their funding costs are getting cheaper, what they can get for their said loans is also getting cheaper. So for example, if a bank pays on deposits 5 basis points and loans the money out at 3%, the net interest margin is 2.5. But if the deposits cost 0%, i.e. there's no interest being paid out on the deposit, but the bank can only make 1% on the loan. Why? Because the 5-year bond might be negative 0.6%. Your net interest margin is now 1% when it used to be 3% or 2.5%. So that's a 60% drop. So that's really what investors are worried about. So Europe is only the second large economy that's suffering through this. Japan has been battling this phenomenon for years. I would ask you to look at any 10-year stock chart of any Japanese bank, and you'll see why investors are worried. These stocks are negative. Most of them have lost over two-thirds of their value, and in our opinion, rightfully so. So the final point, the other headwind that these European banks are facing is that their clients are taking their deposits out. So if you're taking your deposits out of your money, then it basically means that from a bank perspective, you can't make as many loans. Now, another headwind as well, because these banks were very active in either hedging oil and or making loans for oil and gas companies, they have to reduce what's called shrink their balance sheet. And that's a problem for the equity owners. So if they shrink their balance sheet, sometimes they even have to issue share capital. And this new dilution is really terrible for existing shareholders, because they have to share the smaller profits amongst a higher number of shareholders. So what's our conclusion? Buy, sell, or hold. That's really, we have sold our European banks because really the issue is structural. No banker can really get around lower interest rates. It's something they simply cannot control. So we took our medicine, took our losses, and moved on. Our holdings were quite small, less than 4%, and we were down from about 5% holdings. But it's better to lose the first 1% than wait and probably lose more over the long term. Now, many investors will say, well, what about Canada? It's a good statement. It's a good question. Our 10-year bonds right now yield about 1.13%, and the 5 years are about 60 basis points, or about half of that. So right now, the banks can still make some pretty good money, but Canada's recent growth has been built on the oil boom. So one thing that you really want to ask yourself is, the banks have they recognized the bad loans that they've made, and are the deposits going to be pulled from their balance sheet? Is it just a question of time? Or were the Canadian banks that much better at managing their risk? The jury's still out on that, so we're still very cautious. So don't be fooled. You really don't want to chase these things necessarily. So trends rarely reverse into V fashion, and market timing or timing these things can be very difficult. So be wary of the challenges ahead. Thank you very much for watching, and if you have any questions or comments, feel free to give me a call or email me. Thank you very much for watching. Bye-bye.